When China's stock market moves, London reacts. When China's central bank speaks, Wall Street listens. When China buys oil, currencies shift in the Middle East. This isn't about size alone. India's economy is growing, so is Indonesia's, but markets don't watch them the same way. The nervousness around China is rooted in history, and it comes from both sides.
Imagine your country's biggest port, controlled by foreigners, your central bank, run by foreign officials, your railways, your mines, your tax system, all managed by people who don't answer to your government. That was China for 100 years. It started with debt. After losing wars in the 1800s, China had to borrow massive loans from European banks. And those loans didn't come alone, they came with handlers. Foreign banks didn't just lend money, they installed their own people in customs offices. They took a cut of tax revenue. They decided which Chinese industries got funding and which didn't. It's like getting a credit card, then finding out the bank now controls your salary, your rent, and what you're allowed to buy. By the early 1900s, 8 different foreign powers were collecting debt payments directly from China's treasury for 39 years, with interest. China wasn't just broke, it was managed. Then it got worse. In the 1940s, the currency collapsed, not slowly, catastrophically. A bowl of rice that cost pocket change one year cost a wheelbarrow of cash the next. Families watched their savings become worthless in weeks. People stopped trusting money entirely. They traded in rice, gold, anything solid. And here's the thing, this wasn't a natural disaster. It happened because China had lost control of its own financial system. Foreign debt, foreign banks, foreign terms. An entire generation grew up watching their economy get dismantled by decisions made in London, Paris, and Tokyo. They learned one lesson above all: lose control of your money, lose control of everything.
1949. New government. First priority wasn't ideology or politics. It was never again. Never again would foreign banks control Chinese currency. Never again would debt come with handlers. Never again would someone else decide what China could build. So they shut the doors. No foreign loans, no foreign banks. Everything rebuilt from scratch, internally, under complete control. It worked, but it was slow. Growth was limited. Technology fell behind. For decades, China stayed isolated while the rest of the world moved ahead. Then 1978, a choice: open up or stay behind forever. But here's where it gets interesting. China didn't open up the way everyone expected. Most countries, when they open their economies, follow the same playbook. Let foreign money flow in freely, float your currency, let markets decide, open your banks to foreign ownership. China did none of that. Foreign companies could enter, but only with a Chinese partner. Technology could come in, but it had to be shared. Investors could participate, but capital couldn't just fly out overnight. The central bank stayed firmly in government hands. To the West, this looked like protectionism, like China wanted the benefits of global markets without playing fair. But China was watching what happened to countries that opened up the normal way. Thailand, 1997. Foreign money poured in for years, then one bad quarter, and it all rushed out. The currency collapsed in days. The economy went into freefall. Argentina, 2001. Opened up, borrowed heavily in foreign currency. When the crisis hit, the entire financial system imploded. Savings frozen, pensions gone. Russia, 1998. Let foreign investors in, let the ruble float. Then capital fled, the government defaulted, and millions lost everything. China saw a pattern. Open markets without control meant someone else could pull the plug. So they built a different system. Massive foreign reserves, over $3 trillion at the peak. Capital controls that prevented sudden outflows. A currency that was managed, not free-floating. state banks that couldn't be bought out or collapsed by external shocks. It wasn't about efficiency, it was about immunity. The lesson was simple: integration, yes; dependence, never.
Fast forward to today. That lesson is everywhere. When China builds a port in Sri Lanka or funds a railway in Kenya, Western analysts call it geopolitical strategy. And maybe it is, but it's also done through state banks and sovereign funds, because China remembers what happens when private foreign capital controls your infrastructure. When China limits how much money can leave the country, investors complain about restrictions. But China watched the Asian financial crisis. They saw currencies collapse because hot money flew out faster than it came in. When China refuses to fully open its financial sector, it gets criticized as protectionist. But in 2008, while Western banks were collapsing, Chinese banks stayed stable, not because they were better run, because they were insulated. This creates friction. Global markets are used to a certain logic: open systems, free capital flow, currencies that float based on market forces. China operates on a different logic, one built on control, not efficiency. And that makes people nervous. Take the yuan. It's not fully convertible. You can't freely move large amounts of money in and out of China the way you can with dollars or euros. For businesses, this is frustrating. For investors, it limits opportunity. But for China, it's a firewall. It means no one can trigger a sudden capital flight that crashes the economy overnight. Then there's the debt angle. China holds over $800 billion in US Treasury bonds. That's leverage, but it's also exposure. If the dollar tanks, China's reserves lose value. If China dumps bonds too fast, it destabilizes the very system it depends on. So neither side can afford to break the relationship, but neither side fully trusts it either. And you see this in technology: semiconductors, AI, battery tech, renewable energy. China is pouring resources into building domestic capacity in every sector it once imported. Not because it wants to cut off the world, but because it remembers what dependence costs. When your chips come from Taiwan, your software from California, your machinery from Germany, you're vulnerable. And vulnerability, in China's historical experience, gets exploited. So markets watch China invest billions into chip fabrication plants, even though it would be cheaper to just keep buying from Taiwan or South Korea. They watch China subsidize electric vehicle production, even though Tesla was already ahead. From the outside, it looks like unfair competition. From the inside, it looks like insurance. Western corporations want access to China's billion-plus consumers, but they also want China to open up on terms that feel predictable, terms they understand. China wants trade, investment, integration, but not at the cost of control. And that's where the tension sits. It's not going away because both sides are operating from experience. The West sees opportunity and asks, why won't China play by the rules? China sees history and asks, whose rules?